Ladies and gentlemen, we now begin our seminar with the keynote speech by Dr. Marc Faber. As you all know, he's the editor and publisher of the Gloom, Boom, and Doom report. Dr. Faber will share with us his insights on the U.S. exit strategy and the economic outlook for next year.
Well, first of all, thank you very much for the very kind introduction, and thank you for the organizers to invite me. It's very kind of you. And of course, to you, the audience, thank you for giving me the opportunity to share some of my views with you today. I was also one of the early investors in South Korea, partly because I had seen the success of Japan in 1973, and I felt that Taiwan and South Korea would develop along similar lines in terms of new technologies and industries and economic development. And then in the mid-70s, I started to travel to the Middle East, and at the time I went to Saudi Arabia, where a friend of mine, he was the engineer supervising a construction site in the oil industry. And he took me to the site and he showed me thousands of South Koreans that were building at that time and working at that time on this huge construction project in three shifts a day, 8 hours each. And when I saw how hard these people worked in, an unbelievably hot climate, I said to myself, if they can do that, then for sure the country will be very rich one day, because they're hardworking people and entrepreneurial people. So then in 78, for the first time, I bought some South Korean shares. I wasn't allowed to do it under my name, but the South Korean, I allowed me to use his name, so I invested in South Korea. And for the first few years, the shares didn't go up a lot. But just as a reminder, at the time, you could buy South Korean stocks with a PE of 4 or 5 times earnings and a dividend yield of between 7 and 8%. We have the view in the United States that government interventions are desirable to stabilize the economy, to boost economic growth. And in particular, over the last, say, 10, 15 years, the view came up that to create bubbles, in other words, you print money to boost asset prices, would help economic activity. In other words, frequently, the US addressed long-term structural problems with short-term economic policies. And the unintended consequences have been essentially widespread and also have been unfavorable, in particular for the United States. I'd like to point out it's important to understand the philosophy of the Federal Reserve under Mr. Greenspan and also under Mr. Bernanke. The view has been, okay, we target inflation. There are many ways to define inflation, but I can assure you that to define it as core inflation is a complete nonsense, because most people use energy and use food, maybe not at the Federal Reserve, but to my knowledge, all of you will eat and you will use energy for your transportation need, heating needs, and so forth. And core inflation in the US excludes energy prices and food prices. Number 2, the Fed argues we can't identify bubbles. But if a bubble bursts, we can take extraordinary measures that, in the words of Mr. Bernanke, would include dropping dollar bills onto the United States from helicopters. Now, I want to explain, and this is important to understand the problem with money printing. If in this room I decide to increase the quantity of money, is very simple. I can drop the dollar bills from the ceiling into this room, or I can credit each one of you's account with $1 million, whatever it is. And so you have money. That is the simple part. But just consider, if I drop the dollar bills from the helicopter, the dollar bills may not flow equally to this room. Maybe most of them fall down here in front, and at the back nothing falls down, so it creates already an inequality. If I credit all your accounts with $1 million, at least there is some equality in the process. But the problem is with this policy that the money can be printed. The Federal Reserve or any central bank doesn't know what people will do with the money. So what will then happen is that this money will flow at different times into different sectors of the economy. It can flow, say, over there into NASDAQ stocks and boost the NASDAQ. Or it can flow over here into the housing market and boost home prices. Or, under certain conditions, it can flow into wages. Under other conditions, into consumer prices. Under other conditions, it can flow into bond and equity prices. But it will never flow equally throughout the system. And this was already identified as one of the problems of money printing by Copernicus, who was not only a scientist but also an economist. LTCM was a large hedge fund. It essentially, and it was run, of course, by academics. 3 of them had won Nobel Prize in economics. Tells you something about the economic profession nowadays. But in any event, LTCM went bust. And of course, immediately Wall Street ran and said, oh, if they go bust, it will create a financial problem. So the Treasury and the Fed bailed them out. And that gave a signal to Wall Street, you can leverage up. You can increase your debt level indefinitely because there is a guarantee, the Federal Reserve bailout. And if the Federal Reserve would not buy the Treasury securities, at the present time, officially, they say QE3 and QE4 is $85 billion a month. But the actual purchase so far this year is over $1 trillion in 9 months. In other words, they're buying at least $100 billion a month because they have some interest that come due that are accruing from the existing positions. But basically, by buying this government debt, they can finance the government, and so the government can run very large deficits. And the debt then keeps on going. It doesn't matter whether Republicans are in power or Democrats. They both spend. Irrespective, doesn't matter. Basically, we are in a very dire financial position. And here you have exactly, this is not my invention. This is Congressional Budget Office. This is the official government. This would be if the US government was a corporation and would account to GAAP rules. So the official deficit here is 1.3 trillion. The actual is 5 trillion. But these are government statistics, not my invention. But finally, in 2007, September 18th, they woke up, they have a problem, and they slashed the Fed fund rate down to essentially 0, where the Fed fund rate still is today at 0. We are more than 4 years into an economic expansion. June 2009, the economy began to recover. We're still at 0 Fed fund rate. The stock market bottomed out on March 6, 2009, S&P 666. We went up almost 3 times. We still have a 0 Fed fund rate. And I will explain some of the problems later about the zero Fed fund rate. But basically, this is the policy of the Federal Reserve. If it were possible to take interest rates into negative territory, I would be voting for that. Negative interest rates would be basically, you deposit $100,000 at the beginning of the year with a bank, and at the end of the year, you get $95,000 back. So the idea of that, and it's been discussed in the economic literature, including by Gregory Mankiw of Harvard, of course, the idea is that you push people to spend. I'd like to emphasize in this room, countries do not become rich from spending, from consumption. Countries become rich from saving. That allows capital spending to expand. In other words, countries become rich from the construction of infrastructure, the construction of factories, and the acquisition of machinery, and from the investment in education and in research and development, and not from going on holidays and to casinos. But it's much easier to have negative interest rates in real terms. In other words, you have a zero Fed fund rate, and you have consumer price increases, the government says, say around 2% in the US. That is, of course, complete nonsense. Prices in the US are going up by much more than 2%. So you have negative interest rates, strongly negative interest rates, maybe in the order of 5% per annum. And that, of course, creates, again, a misallocation of capital. First of all, it penalizes people who have savings. If I have $1 million on deposit with a bank, I get essentially here zero interest rate, but the cost of living are going up by, say, 5% per annum. So the purchasing power of my money diminishes. So I'm essentially forced to do something with my money. So I can buy stocks, the stock market goes up, or I can buy bonds or build a factory. But unfortunately in America, hardly anybody builds the factory. Everybody speculates here in the share market. And so it creates, again, a lot of uncertainty. I just touched upon one thing. By having negative real interest rates, you penalize people who have deposits. Now, here is the interest income in the US. It's down by over $400 billion. The dividend are up, but not by $400 billion, but something like by $100 billion. So one of the reasons the economy is not recovering much is that lots of people, their interest income has vanished, it's gone. And one of the problems is it's very difficult to cut spending, because 75% of spending are mandatory. They are social security checks, food stamps, and so forth and so on. And it's as Jean-Claude Juncker said, we all know what to do. We just don't know how to get re-elected after we've done it. What to do means you have to cut spending by the government. In most European countries, and by the way also in the US, if you include the cities, the municipalities, the states, and the federal government spending is something like 45, in an extreme case, France, 56% of the economy. It's a very high level, and you have to see government is like a cancer. The bigger it gets, the less economic growth there will be. You see, the problem will become even worse, because now the retired to working population ratio is worsening. In other words, there are less and less people working and more people retiring. So more and more people have to support the elderly. The elderly, they want their social security check. They want to get as much out of the system. The problem we are faced today, they are there because the people who work for a living are now outnumbered by those who vote for a living. People vote for a living in the US. They don't work for a living. That is the problem. Downtrending interest rates are very favorable for corporate profits and, of course, for asset markets in general, for stock markets, bond markets. But here I wanted to show you how essentially how it is unusual that we are essentially in a very weak economic expansion, and yet in the US we have record corporate profits. The stock market is not terribly expensive, but the corporate profits are at an elevated level. And one reason is that each time interest rates come down is very favorable for corporate profits. Now, the blue line are corporate profits as a percent of GDP. Here, blue line, corporate profits. As you can see, as a percent of the economy, corporate profits are now at the highest level in history in the US, as a percent of the economy. The red line are the real Fed fund rate inverted. In other words, when the red line goes up, the Fed fund rate goes down. So here, interest rates go down, corporate profits expand. Here, after 2001, interest rates go down, corporate profits go up. Here, 2007, interest rates go up, corporate profits tumble. 2009, interest rates go to zero, corporate profits boom. That is the pattern. So, if we talk about money printing, who benefited the most? Not the people who work, the middle class, the working class, corporations. As a result, the stock market went up. You know how many people benefit from a rising stock market in a society? Maximum 5%. In the US, they calculated most of the gains, I'll prove it later on, have accrued to 1% of the population since 2007. 50% of the population still lost 44% of their money. Another point about government spending. But here I just wanted to show you a figure. This is government spending as a percentage of GDP between 1870 and 1913. Nowhere was it more than 18% of the economy. And that period is a period of very strong economic growth, very strong real per capita income growth. In other words, the standards of living of people went up a lot, but as I said, government spending was very small. And now we just have governments that are too big. And look, the larger the government is, the less economic growth there is. I can prove it to you. In societies that were socialist, communist, China, Mao Zedong, Russia under communism, Eastern Europe under communism, Vietnam under communism, the standards of living of people was horrible. And all these economies completely collapsed. They didn't grow. So the bigger the government, the less growth there is. If all the government would have to do is to tell people, here you produce and here you consume and so forth, on paper it sounds good, but in practice it doesn't work. But it creates, of course, huge wealth inequality in the system. And then you have a dysfunctional political system. Many poor who vote for people like Mr. Obama, and the few rich, they try to protect what they have, and then they can't agree on anything. This is long-term, or has long-term been a problem of US economic policies. In the 20s, already before Keynes came up, the idea was born that because people save money, say 10% of your income, the economic system will continuously have some kind of underconsumption, not consuming enough. And so the government's economic policies have to be designed to push consumption up, either through government spending or through economic policy measures. So, as you can see, since the 1970s, actually since the 60s, net domestic capital spending, it is a capital spending as opposed to consumption, has been trending down and turned negative here in 2009. Now it's up slightly because of the oil and gas industry. But basically, there's no capital formation in the United States. That should be clear. There's some new capital spending which is offset by the obsolescence of other capital projects. So here you have consumption going up, capital spending going down, and so imports go up. The trade deficit in the US expanded from $150 billion annually in 96 to $800 billion. Now it's been shrinking again somewhat in the recession. Then it expanded again. Now it's maybe shrinking again because of the oil and gas industry. But basically, you had this huge trade deficit. So that you have consumption in the US because the dollar bills flow into this room. The production is next door in China. And the capital spending is in China. Employment gains are in China. Income gains are in China. And so essentially, Bernanke's monetary policies drove economic growth in China and other Asian countries. Expansionary monetary policies and artificially low interest rates lead to excessive credit growth. This is credit growth, this is credit as a percent of the economy in the US. It expanded rapidly here in the 20s. Then we had the depression and we had a period of deleveraging. And for most of the 70s, total credit as a percent of the economy was 120, 140%. After 1980, you can see credit grows at a much faster clip than the economy. This is what I call a healthy credit. I'm not saying every project will make money. Some projects will fail. But for sure, if you borrow for consumption, let's say we all borrow money to go on a holiday, the immediate impact on the economy is there, but not a lasting impact like building a factory that produces goods. So we have to distinguish in the quality of credit. The qualitative distribution of credit is very important. In South Korea, we also had a highly leveraged economy in the corporate sector and the government sector in the 60s and 70s, but the credit was not used for consumption. It was used to build the factories and the infrastructure. Now in the US, in the last, say, 20 years, most of the credit was household credit. And the household one day runs out of borrowing power, doesn't have any more money to borrow more, doesn't earn more. And that household credit grows. And this you have to remember for South Korea as well. This boosts temporarily the economy because it takes, if you save money every year, say 10% of your salary every year, after 10 years you can buy a car. But if you borrow, I can buy today the car that otherwise I would have bought in 10 years' time. But you understand, I just advance consumption from the future. And one day the limit of future borrowing is limited, and then the economy automatically slows down. I mean, this is the simplest equation for someone to understand. Number two, I mean, it doesn't take an economist to understand that if you borrow money to build a factory, and you buy the machinery, and you buy the raw materials to produce something, and then you sell the products, and you generate the cash flow, and from that cash flow, you pay the interest on the debt, and eventually repay the debt. This is what I call a healthy credit. There are 2 points I want to make about credit growth. One is here, in 1929, the peak credit to economy was 186%. Now we're at 370, 380%, doesn't matter. But at that time, we didn't have Social Security, we didn't have Medicare, no Medicaid, and not the unfunded liabilities from these institutions. Now we have them. So the total credit as a percent of the economy is not actually here, but somewhere in the 5th floor of this building. But when the private credit growth slowed down, they woke up and said to themselves, well, we have a problem. Our economy can only grow if credit grows. So the private sector growth is slowing down. We, the government, have to step in. So they stepped in with fiscal measures and monetary measures. The deficit went up. So the red line is the US government's credit growth. So the credit growth from the government accelerated, and the Federal Reserve financed it. I was recently with a former member of the Fed, and we were talking about monetary policies. He said, Mark, the US government, the Treasury Department, and the Federal Reserve is all one and the same. No difference. The Treasury issues the bonds and the Fed buys them. So basically, what you have is a very heavy intervention in the economy. So you have 2 companies. One has no credit. In other words, it's all financed by, say, 3 partners, cash, no borrowings. Another company has borrowed a lot of money and has equity of, say, 10%, and 90% is borrowings. Now comes a recession. Which company do you think will go bankrupt first? The company with the 90% debt will go bankrupt first. The company that only has equity, whether business is good or bad, you just tighten your belt a little bit, but you don't go bankrupt. And the same happens to countries and societies. And probably last side effect of bubbles is this. You have consumption going up, capital spending going down. It leads to an overconsumption, of which one of the symptoms is an expansion in the trade deficit. China was, in the year 2000, still in the early stages of economic development. As they industrialized, as consumption went up, as capital spending went up, they drove the demand for commodities up. And so the prices of commodities here went up very strongly. In any event, China drove up commodity prices, and of course, what then happened is that the commodity producers benefited. Africa, Latin America, Argentina, Brazil, Venezuela, Central Asia, Russia, the Middle East, and Australasia. This is world export value. This is G7. These are the industrialized nations of the West and Japan. Their exports as a percent of global exports going down to now just over 30%. Rest of the world, including South Korea, this is emerging economies and, say, more advanced non-members of G7. That share is going up. Very interesting. Industrial production. Advanced economies, flat. Emerging economies since 2000 essentially has more than trebled industrial production, and the rest of the world is flat. We live in a new world where the Western world, Western Europe and America, is becoming less important, that it is China that is the most important economy. The US is 70% of the economy's consumption. Of that 70%, 70 are services. Services do not require copper, they don't require iron ore, they don't require oil. China is an industrialized nation in the early stages of industrialization. When its economy grows at 8%, the demand for commodities goes up strongly. When the Chinese economy doesn't grow, the demand for commodities is flat. The US is not the driver of commodity prices, nor is Europe. China is the export destination. This is for China. US, blue line, as a percent of total exports, it's going down. EU, dotted line, as a percent of total exports, going down. The red line, commodity producers, Middle East, Central Asia, Africa. China trade with Africa is twice the size of America trade with Africa. So if the Chinese economy slows down, what do you think it does to demand for commodities? The important point is the exports of China to commodity producers are larger than to the EU or to the US. Now you may say, well, this only applies to China. The world hasn't changed that much. So you tell me, which country is more important for the global economy, China or the US? Of course, China, because if the Chinese economy goes from a growth rate of 8% to, say, 4%, it has a huge impact on commodity prices here, on this. And if the prices of this go down, it has a huge impact on the economies that are the customers of here, China. These people, these are the customers of China. They're also the suppliers of China. You have to also think, what are the geopolitical implications of countries becoming China-centric? If your exports to China are larger than to the US, who is going to be your boss? If you have in a company one huge customer, who is more important? Your boss in the company or your huge customer? The huge customer doesn't like you or doesn't like the company, he will tell you, look, you better go and work for another company. He is your boss. And so China has become a very important geopolitical player. This is the share of world's commodity consumption by China. From essentially nickel to cement, they now have, as a percent of world's consumption, roughly 40 to 50%. That was 10% in year 2000. Question, can they grow much more? They have now, of the iron ore market, 50% of the world's iron ore goes to China. You think it will go to 100% of the world's iron ore production? No. At some point, there is a slowdown. And you can see here South Korea, oil demand went up strongly during the industrialization, up until 97, and after it's flat. This will happen in China for commodities. Maybe not for oil, but for other commodities. Number two, China has had two phases of strong economic growth in the last 12 years. The first is what I call normalized economic growth. That was the period essentially 2000 to 2008, when credit expanded at about the same rate as nominal GDP. But here you can see that over the last couple of years, credit as a percent of the economy has grown in about 4 years by 50%. No country has had credit as a percent of the economy grow by 50% in 4 years' time. And this excessive credit growth, regardless, sooner or later will slow down. Maybe they can keep the party going a little bit longer. But the longer they keep the party going, the worse the downturn will be thereafter. Without this excessive credit growth in the last few years, the Chinese economy would not have grown at all. Zero growth. They would have been in recession. With this credit growth, the economy was able to expand, but at the cost that there will be a more significant slowdown. In the case of oil, the per capita consumption is still very low, and the demand, as you can see, in the last 15 years has trebled. We're now at over 10 million barrels a day. In the next few years, there will also be geopolitical issues that we need to address. If you are Chinese, what is your number one priority? Number one priority. You now are a Chinese strategist, not an American politician. As a Chinese strategist, what is your number one priority? You need 50% of the world's iron ore. You're now the second largest oil consumer in the world after the US. You need copper. You need food. Priority is the supply of commodities. No oil in China, the whole economy collapses. Problem is that most of the oil comes from here, the Middle East. It comes on the sea lanes around the tip of southern India, then through the Strait of Malacca, up the Vietnamese coast, into the northern ports of China. And the Chinese are, of course, very concerned about the securement of oil. And in my view, this will lead to some problems here in the Middle East and to increasing tensions with the United States in Central Asia. And so I think that the situation in the Middle East will become very tense. The Chinese, of course, they are aware that they need the Middle Eastern oil, so they're not exactly cooperating with the Western powers, nor is Russia. One way for China to become a little bit less vulnerable, you see, one of the problems of China is they have access to the East and South China Sea, but they're surrounded by American bases. And the Americans have 11 aircraft carriers. So if you're China, you really feel essentially encircled because the Americans are also here in Afghanistan, and they feel threatened. So they build already pipelines here through Myanmar. They build pipelines to Turkmenistan. They will build one to Kazakhstan and to Russia. But still, they are very dependent, and I'll tell you why. They own already Southeast Asia. Look, you go to the Philippines, Malaysia, Singapore, Thailand, Indonesia. Outside the government, 80% of businesses are owned by Chinese. These Chinese, their loyalty is to China, not to Indonesia or Malaysia or Thailand. And they have close business ties, family ties with China. So the influence of China in Southeast Asian affairs is already huge. They don't need to invade the Philippines. But strategically, they may want to have some of these islands, from the Senkaku Islands here to the Spratly Islands and so forth. That may be the case. But I don't think they have any territorial ambition per se in the Philippines, nor in Indonesia or here Southeast Asia. Normally, in a system, the safest is cash in a bank or treasury bills. But is it safe today? I'm not sure. We had the experience of Cyprus. In Europe, they want to do the same in the next crisis, to penalize large depositors. So I still recommend essentially the diversification into equities, cash and bonds, real estate and gold, and to essentially reduce leverage. Now, how much in equities, how much in cash and bonds, how much in real estate, That depends on each investor. In general, the last 12 years, 2000 to 2008, the best investment were commodities. Copper, oil, silver, gold. Now we have had this underperformance of stocks vis-a-vis commodities. Now I think stocks may perform in line with commodities. You know, that the outperformance of commodities has come to an end. I would still own gold, but I don't think that industrial commodities will perform very well. And a year ago, in May 2012, the European markets had collapsed because everybody was so negative about the EU, with the result that Portugal, Spain, Italy, France, Greece, these markets were at or below the 2009 level. But the US had more than doubled already. So relative to the US market, European stocks were very cheap. And in some cases, you can see the dividend yield of European stocks were much higher than the bond yield. I still think, relative to the rest of the world, some European companies are quite inexpensive. Gold, there is a lot of talk about gold, whether the market is manipulated or not. Basically, I don't believe that the market is manipulated. Basically, the case for gold is this. The advanced economies, the central bank reserves are large. In the developing world, in emerging economies, central banks, they have the reserves, but they don't have any gold. So I think that over time, countries like Russia, China, India, also South Korea will acquire gold, and therefore, and other reasons, for other reasons, also therefore the price will rather go up. As you know, the economic geography of the world changes very rapidly, and what was growing rapidly for the last 30 years may not grow rapidly for the next 30 years. And so basically, as the philosopher Karl Popper said, in an economic system, if the goal of the authorities is to reduce some particular risks, then the sum, in other words, all the added risks of all these suppressed risks will reappear one day through a massive increase in the systemic risk. And this will happen because the future is unknowable. There's a very good book. It is very easy to read, and I'm sure it's been translated into Korean as well. Milton Friedman's Capitalism and Freedom. And basically, he explains that obviously the bigger the government becomes, the slower economic growth is, the more it creates wealth inequality, the more social security you have, the more poverty you have, and of course, the larger the government, the less freedom you have. The risks, the problems are continuously postponed with monetary measures, with fiscal measures. And one day, in my view, the system will collapse, undoubtedly. Before it collapses, they will print even more money, and maybe they'll go to war. But I can tell you, a lot of the young people in this room will have big economic and financial disappointments in the next 10, 20 years. But don't be depressed when you walk out. It's here. My wife is a Keynesian. She always spending herself out of depressions. That is what the governments are doing. Thank you very much for your attention.
네. 자, 다시 한번 마크 파버 박사님께 큰 박수 부탁드립니다.
Thank you.
Thank you, Dr. Faber.
Should I go down?
You may sit down. Thank you.